So credit, it's just a tool in our tool bag that we have to manage our businesses. It can be very helpful, but also if used inappropriately or in the wrong manner, it can not do us very good. And so we can get in a bind using credit, but it's a good tool when we use it correctly in our businesses. So you might say, well, what is credit? It's a means of borrowing money from a person or a company, returning it at a later date with interest. Since the financial crisis of 2008, we've seen interest rates at record lows again. And so that's been a good thing as a creditor. Credit is one thing, but being credit worthy is what bankers are interested in us. And really credit worthiness is just the willingness to pay it back. When bankers loan money, they want it paid back. They really don't want collateral. And so they try to assess our credit worthiness, whether we're a good credit risk or not, and we'll talk about credit risk a little bit more. So from the perspective of a borrower, we have to communicate our idea to the lender. And if we're going to get a loan, it has to be successfully convincing the lender to loan us some money. So how do you package your idea and convince a lender to own us money to buy those high-priced calves or those high-priced heifers? And so here's a checklist that we can put together in order to present our case to a lender. First and foremost is a balance sheet, a net worth statement, a financial statement, income statement, or maybe tax returns. Sometimes they'll say, well, I need the last 3 years of tax returns. But an accrually adjusted income statement is part of the package. That's part of what they want to look at. Our production records, have we been successful? Are we a good risk? Can we make cattle gain? Can we keep them alive? Can we keep them healthy? Can we market them good? And so these are things that a lender will look at for producers. And then we got those cash flow projections, where we might look at our expenses and our income streams on a monthly basis. Sometimes referred to as a pro forma, a financial projection of our business plan, you might say. And then, of course, that's kind of the last thing. So what are you going to do with the money? How are you going to make more than the interest rate to pay that back? And so this is kind of the package of documents that we would prepare in order to communicate to a lender that would allow us, hopefully, to be able to successfully get a loan from them. Just kind of a couple of slides here on where you might can go to get some of these documents. A net worth statement is at the foundation. And of course, this is what one kind of looks like. The main parts of it is on the left side, usually your assets. They're broken down into current assets and then non-current assets, and your liabilities on the right side. We've got current and non-current, and then when you get down to the bottom, the difference between the two hopefully is a positive number. That's when you're solvent and you have a net worth, and so that's how it's calculated. And usually in the process of completing this, it's nice to have schedules behind those numbers so you can tell, well, if we've got $100,000 worth of cattle, then what's that made up of? Is that steers, heifers, little ones, big ones? They ready to sell? When are they going to come to market? At what price have you got projected for them? And so it's good to have these schedules behind those documents, net worth statement here. And if you're interested in being able to use this, there's the web address as to where that is on our website. It's an interactive Excel spreadsheet. You just enter the numbers and it does all the math for you and puts them in the right place. And so it's a good place to get a net worth statement and get it filled out with your numbers. So the checklist here continues is something that you need to understand before you actually sign on the dotted line, what your obligations and responsibilities are. Is it annual payments? Is it quarterly? Is it monthly? What kind of documentation going forward are expected of you? Cost of fees, loan origination, and annually. A lot of times there's filing fees that you have to pay for. If it's a real estate loan, you have title opinions and recording fees. And so try to have a good understanding of what those are. You know, and some organizations that you borrow money from, like Farm Credit, they require an amount of stock because it's a cooperative. When you borrow money from the Farm Credit system, you become a stockholder and owner of that system, so some stock is required. Sometimes other lenders require a balance in an account that you have to keep at a certain level. So know what those are. What about, does it have a demand clause? Can the lender call that note at any particular point in time? Because if you're in the middle of you bought some young cows and they're now 4-year-olds and you still got a couple of years before they're going to pay out possibly, and can they call that note ahead of time? So it's good information to know. Type of loan payment, again, what's the period of time that you need to make those payments? Is it paid fully at maturity? You know, is it revolving? Can you spend money out of it, pay it back, spend it again, pay it back? Or is it just, to buy a tractor, buy some cows, and that's all, specific title there? So what's expected of you in terms of repayment? And then when it comes time to renew, is it only just principal? I recently had opportunity to travel what some people call down under in New Zealand and learn that some of the ways that they do business down there is a little different than we do in terms of borrowing money. And many of their operating loans, when they pay back, are interest only, and they just loan a line of credit and only expect interest back. So a little bit different. So it's good that we understand what that is. And this is something that's not always received by a borrower at the time that a loan is taken out, is an amortization schedule or a payment schedule of what that is. How much each payment is principal and interest. Because, when it comes tax time, we made a $20,000 payment to the lender. Well, how much of that was principal and how much of that was interest? Because principal is not deductible, but interest is, so we need to know the breakdown of that payment. And of course, is it fixed, variable, or adjustable? And I think that may be influenced by what your outlook for interest rates are. Because if we think fixed interest rates are going to be going up, then we'd probably want to try to get a fixed interest rate. We thought they were going to go down or stay the same. Variable's usually a little bit cheaper, but there's more interest rate risk in that. And a lot of times if they're adjustable, how much can they adjust? What's the cap that they can be adjusted, and how often can that interest rate be adjusted? About the period for the caps there. And then if there's any prepayment penalties, a lot of times, we might sell those calves for a little bit more money than we thought, and we could pay it off early. Is there any prepayment penalties for that? And again, during the year, what kind of reporting requirements? Do we have to fill out an annual net worth statement or update those documents throughout the year? So what are we expected of us? Consequences of a late payment. Bankers don't like to be surprised. They like to get paid on time. And I think this last one here that I've got listed is really, really important concerning the lender's institution and history about being involved in agriculture, because we're somewhat unique how we do business. Weather affects sometimes our repayment capacity. Sometimes we need a little bit longer time to repay because of markets or weather that are somewhat completely out of our control. What's the particular agricultural experience of your individual loan officer? Do they know about agriculture? And how about your operation? Do they make an effort to try to learn about your individual operation? Learn how you make money on your particular ranch or farm. So these are kind of things from a borrower's perspective, looking at it. And so let's kind of, again, swap sides of the table and try to get in the mind of a lender and see what they think from their side. So what's credit risk to them? Well, it's just the what arises from a changes in a customer or a counterparty's ability to pay the funds back, to pay the money back. So managing risk is really what bankers get paid to do, is how, we have to manage a lot of risk in our businesses, weather, market, price, labor, interest, but they get paid for managing credit risk. So when they look at our application or our ability for them to take credit risk on, they want to feel comfortable that they can get their money paid back. So they have to balance, though, a good credit decision based on the ability for the institution to accomplish their mission and make a profit, and in serving the community in which they're located in. And then they have to protect the safety and soundness of the bank so they'll be there in the future. And these are the things that a banker looks at to manage this credit risk. They may have loan limits for a particular individual, like we're not going to loan more than $10 million to any one entity. They look at counterparty, if they try to limit individual risk with some of these counterparty entities. And in an industry, they might say, well, for instance, dairy or poultry, that they'll only going to put so much of their portfolio invested in that. And so these are ways that a lender may decide, well, we're going to limit those in case, just like we've seen over the last 3 years in the grain industry, that they kind of had their day back in 2012, 13, and it's come down since then. But the livestock industry has really prospered in the last couple of years. And so if they can diversify their portfolio, some into grain, some into cattle, well, they ought to be making money all the time there. So, and they use this also in their lending policies and credit manual, the process that they approve those. Enterprise risk, and try to, they may limit the amount of money they put into stocker cattle. That's just ways that they help manage some of this risk, and then they have underwriting standards that they look at. And a lot of times they refer to those as the 5 C's, talking about character. It's our integrity, what's our credit history been? Capacity. Sometimes this C is referred to as cash flow. This is the primary source that a lender looks at to repay the loan, because when we get down to collateral, they look at this really as a secondary source. Bankers just want to get paid back. They don't want their land or cattle. They want to just get paid back. And then, there's a phrase that cash is king, and if you've got capital, cash, they look at that to think that's a very positive, builds the case more. And then what are the intended purposes of the loan going to be? Do you have history in managing that type of a loan? There's other ratios that they do that help them look at your liquidity. Your working capital, if something goes sour on you, cattle prices declined $40 a hundredweight like they did since Christmas. Can you withstand that and still be liquid? Profitability, repayment capacity, efficiency. They look at things like debt to asset ratios, one of the most common. And then once the loan is made, how do they manage that? Try to keep current financial data, so you're always filling out documents, updated financial statements. And they monitor the covenants, the agreement that you had before. And then they're going to do some audits to make sure that cattle, equipment are still there. So some of the sources of funds for commercial banks is usually deposits, and they can borrow from Federal Reserve banks. The Farm Credit System, they issue system-wide debt securities to generate their money, so different sources there. Let's talk just a minute here about the general condition of the agricultural industry concerning their finances. There's a lot of information here on this graph, but this debt to asset ratio is just simply a percentage of how much debt is in the average operation. If you look at the last 30 years, we had about 14% of our farms and ranches had debt on. About 14% of it was debt. You look back here in the 80s, debt got up above 20% of our operations, whereas today we're only actually about 10% of our operations has debt. And so agriculture is in really strong financial condition. But here's the year 14, and it's projected 15 to rise. And so time's probably not going to be quite as good going forward. Our percent of expenses compared to our revenue stream, production inputs are going to go up. So just kind of be prepared for that. They're going to be going up through 15 is what they're projected. Value of farm real estate is going to kind of start to flatten off here. And if we look at who loans to agriculture, the Farm Credit System's the biggest one, having about 42% of all of the market share in agriculture at about 86 billion into the real estate. Bankers next, and we got life insurance companies, individuals, etc. So now we're going to spend the remainder of our time talking about interest rates. And in order to talk about interest rates, we have to understand a little bit about the Federal Reserve. And because they're the ones that determine monetary policy for this country. Often referred to as just the Fed. It's over 100 years old. It's really the bank of the U.S. government. It regulates all financial institutions in the United States. And America being the largest economy in the world, it watches over that. So it's one of the most powerful organizations on earth. The duties of the Federal Reserve to promote sustainable growth. They like to have high levels of employment, and they can do that with really how they manage the money supply in the United States. They try to provide for the stability of prices, not highly inflationary or deflationary either. Try to preserve the purchasing power of the dollar and moderate long-term interest rates. But primarily, they devise and implement monetary policy, which affects each one of us and really the whole world, because the U.S. dollar is the basis for trade for the whole world. So monetary policy, again, refers to the amount of money and credit that's in the U.S. economy. And this change of that supply impacts interest rates. And so in order to try to get an outlook for interest rates, we have to kind of understand how the Board of Governors and the presidents of these Federal Reserve banks are thinking how the economy is doing, because that does impact the performance of the U.S. economy here. And when you reduce interest rates, which they did, since 2008 and the financial crisis, they put a lot of money into the economy, and typically when you reduce interest rates, it's referred to as the economy heating up. The gross national product increases and inflation starts to increase. Although we've not seen that yet, and that's the reason interest rates are still as low as they are. And so the tools, we talked about, credit as a tool that we have to manage our operations. What's the tools that the Federal Reserve has in order to manage the economy, the monetary policy of the economy? And there's three of those. One of them is open market operations. That's where they buy and sell government securities. And we've heard the term quantitative easing for several years now. In fact, up until last October 2014, when they ended quantitative easing. And what that is that they were buying a lot of government securities. They was printing money and buying those and putting that out into the economy, hoping that decrease interest rate, make credit easy, hopefully help us to think about buying, spending more money, and getting the economy jump-started again. But that was their tactics. That was their strategy over the last four or 5 years. They can set the discount rate, which is actually the rate at which banks borrow money from these Federal Reserve banks. And so low interest rates encourages banks to borrow money, lend it to us borrowers at a cheaper rate, and try to increase the level of commerce and consumer spending throughout the U.S. The third is setting reserve requirements, which is the amount of physical reserves that banks have to maintain in their institutions. And if they increase those reserve amounts, it tightens up the money supply and keeps more of it in the banks. So those are the three tools that the Federal Reserve have to manage monetary policy. And when they meet and when they say something, the media, they study every word that they have in their news releases. For the last part of last year and the first part of this year, they've had one term in some of their press releases that they called patient, that they were going to be patient about increasing interest rates. And all the news media has kind of picked up on that, and in just this last week have struck that one word talking about their actions for the future and saying that they're not going to be patient anymore, that they're going to be looking harder at interest rates. And so as they meet in April and June and going forward, there will be very intense coverage of those meetings, because when they took out patient in terms of their outlook for increasing interest rates, that kind of give a signal that, well, they're thinking much more serious about increasing interest rates. But their intent is to maintain steady growth, not up and down, volatile. They like it steady, where it's dependable. Extremes are bad, because too fast a growth causes inflation. We don't want that. And too slow a growth causes this recession. Actually, recession is when you have a negative GDP for 2 quarters or more, and then we're in a recession. So to slow the economy down, which is what they will be doing going forward if they think growth has been sustainable, is instead, earlier we talked about buying government securities, what they've been doing, then they're going to start selling these and taking money out of the economy to kind of slow it down, to keep from inflation from happening. So we increase the federal funds rate, increasing rates that banks borrow from them. So again, it's going to kind of tend to slow things down. But see, it's a balance for them to figure out that, well, we want the economy to grow, but we don't want it to be inflationary. So to increase growth, what they did in 08, 9, 10, they bought securities. They put money into the economy, and they reduced the Fed rate. We've got historical low, almost zero interest rates that banks borrow money from. And that's the reason that when we've got $100, $1,000, $10,000, and we take it to the bank, we want them to pay us interest on it, and they offer us, 0.25% or something very low. Well, then their alternative is they can borrow money from the Federal Reserve Bank at a very low rate, so they're not going to pay us anything for our money. So the goal is to get the right balance. Where the media really gets involved in this, and the stock exchange, they can make a statement about what they think they're going to do about interest rates, and the stock market will go down 300 points or up 300 points just based on a word or two what they say. And so sometimes they maintain rates at current levels, but they issue a warning that maybe a possible change might be coming in the future. And that's kind of where we're at right now as we look at what interest rates are going to do for the future. And this warning is referred to as a bias. But this means that the Fed thinks rates are fine, but there is considerable threat that economic changes would warrant a rate change. And so again, that's kind of where we're at right now. We've been record low. There's not much chance of it going any lower, and so it's likely it's going to go up. So in wrapping up here, here's the 17 members, the 12 presidents of the Federal Reserve Banks, and the 5 Board of Governors that are here. That it says appropriate timing of policy firming, meaning it's when interest rates are going to go up, is at 2015. So 15 out of 17 think 2015 is the year when they're going to start firming up monetary policies, when they're going to start increasing interest rates. Only 2 of them says, well, we probably think it should wait until 2016. So again, you read into this, I'm just going to present you this information, and we'll try to draw some conclusions as to what that actually means. GDP growth, they like for it to be up here in the, above 2%. This is going forward, 2015. You know, this is the range in which they think it's going to be in. We've kind of been a little up and down here. If you went back to 2.8 or 9, you know, this would be down here in the negative area. But this is kind of where they think it's going to go, trending downward just a little bit. So they don't want to increase interest rates a whole lot. They just kind of want to nudge them up a little bit to be sure that we don't encounter inflation with the tremendous amount of money supply that they've injected into the economy since 2008. So here's the unemployment rate. You know, again, they try to keep full employment. It's never going to be zero. Full employment is with about a 5 to 5.5%, 5.6% unemployment. And so they think that's where it's going to be. So they feel, you know, again, back earlier we were up close to 10%, but that's fell over the last 6 years or so, and they're pretty comfortable that the economy is going strong enough. A lot of jobs have been created, and so they feel pretty good where employment's going in the future. The other thing they worry about is inflation. They try to keep that at 2% is their goal here, and it looks like it's going to kind of go there. So they think, well, maybe it's getting close. And so here's the kind of the last chart here is that we look at 2015, and here's our interest rates. The Fed rate is over here. You know, we're just really almost down to zero. So these are the 17 folks that think, well, is it time to start increasing? And if so, by how much? And so it's not going to be a huge amount, you know, 3 or 4%, like maybe out here into the future. But here's a progression from 15, 16, and 17 of where these 17 people think interest rates should be going over the next 3 years. So here, probably in 15, you know, several of them think we need to move it up to 0.5 to 1, maybe as high as 1.5% for the federal funds rate. For sure in 2016, 17 any higher, and so longer term, they're thinking that the federal fund rate should be at 3.5 to 4.5% up here. And so that's kind of what I think we can look forward to as monetary policy for the Federal Reserve. And I think, you know, we have to understand what the actions of the Federal Reserve are, what they're thinking as we think what's going to happen to interest rates in the future. So with that, I'll turn it back over to Ron, and look forward to visiting with you more later in the day. Thank you very much.